Well, this is an exciting video. We are now moving out of spreadsheets and T accounts, keeping track of our transactions, and we are moving into big kid accounting. We're going to learn how to do journal entries. This is exciting stuff. Congratulations. In our other videos about analyzing transactions, we started with our kind of chapter 1 version of the expanded accounting equation. And then we went into using T accounts to track our debits and credits. And now we're going to jump right into what real accountants do, which is journal entries. So this is the way that you'll be doing your accounting transactions from here on out for however many accounting classes you take. So we're going to use our same transactions that we did for our spreadsheet version of analyzing transactions and for our T accounts version of analyzing transactions. So again, this spreadsheet is available for you to download it. It includes all of our transactions, includes our chart of accounts, and each one of these methods with the solution side of it so you can see whether you did things right. So let's jump into talking about our journal entries in general. So here we go. This is a typical setup for a journal entry. So we've got a date, we've got an account name, we've got a debit and a credit column. Debits on the left, credits on the right, always going to be that way. And then within this journal entry, we're going to give it a date. We're going to give it a debit account and a credit account. When we do our credit accounts, whether there's 1 or 21, we are going to indent so that it's easier to read it as you're scanning down a spreadsheet full of numbers. And then a lot of times in the textbooks that we use, it will say that explanations or descriptions are omitted for the purposes of the class. And that's really not good accounting practice. And the reason for that is when you put this little description in here, it helps to jog your memory about why you made that entry, but it also helps to set up footprints so that if another bookkeeper or accountant comes in after you, they're able to follow along with what you did and they don't have to come bug you and ask you a lot of questions. So for the purposes of our exercise here, we're going to include our descriptions, and in the accounting textbooks, do whatever they tell you to do, whether it's leave them out or include them. But basically what we're going to say in that description is to record something or other. So in this example, to record revenue from cash sales. So this is the format that we're going to use. And just like with anything else that we've been doing, debits are on the left, credits are on the right. Every debit has to have a credit. Every journal entry has to equal on the debit and the credit side. Now, journal entries can have multiple accounts. So you can have a journal entry that contains, 15, 20, 30 different accounts. It happens that way sometimes. If you're doing like a big adjusting entry at the end of the year, it can have a lot of different accounts to it. So let's dig into our transactions and we're going to do the journal entries that go along with them. So first thing that happens, we open a bank account, and I'm just going to make up dates because I didn't really assign any. So we open up a bank account to start this business bank account and to record that the owner is putting money into the business. So what are we getting? We're getting cash. So we're going to enter cash of $55,000. And then the other side of this transaction is going to be an owner's equity account. So in this case, we have an account called Joe Smith Capital. And we're going to come over here on our credit side and we're going to put $55,000 in. Boom, there we go. And then our description would be something like to record owner's investment. Journal entry done. Look at that. Woo, this is so exciting. And then I'm going to skip a line just for clarity. Back in the olden days when I started out in accounting, we were doing this in green ledger sheets. So it doesn't matter as much here, but it made it easier in green ledger sheets if you skipped a line and you're trying to scan down through a whole line of journal transactions. So the next thing that happens is we purchase office supplies on account. And I'll use 6/1 as my date again. So what are we getting? We are getting supplies. And this is supplies, the asset account, not supplies, the expense account. So we got $3,300 worth of supplies. And then how did we pay for them? Well, we haven't paid for them yet because it says that it's on account, which means that it is accounts payable, which is a liability account, so it's a normal credit balance, and we are increasing that by crediting the account. Boom, another journal entry done. We are cooking with gas. All right, so what happens next? I can't wait to find out. It's always so exciting to see what happens next. We received cash. Woo, love that. From fees earned, $18,300. So what are we getting? We are getting an increase to cash of $18,300. And then we are indenting, and the other side of this will be our revenue account fees earned. Whoops, fees earned-o. Earned-o. For $18,300. And you see that I already forgot to do something. We're going to jump back in here and say to record purchase of supplies. And then here we're going to say something like to record cash sales. All right. And then what happens? We're going to pay our rent. So we're paying our rent of $8,300. So let's see, rent expense, we're going to debit because it has a normal debit balance. So $8,300. And how are we paying for that rent? Well, we're going to pay cash. So we need to reduce our cash account by crediting it by $8,300 to pay rent expense. All right. Then what happens? We pay creditors on account for $22.90. Well, the only creditor that we know of, because this is a new business, he's only bought one thing, is we have this accounts payable here that we increased by $3,300. So now we are paying part of that bill, which means that we need to reduce our accounts payable. We increase it on the credit side, so we're going to decrease it on the debit side. Okay? So accounts payable, we're going to reduce it by $22.90, debiting it. And how are we paying for this? Well, it's coming out of our cash account, so we need to decrease our cash by $22.90 as well. This is to pay for supplies or something along those lines. Okay, and then the next thing that happens is we're going to bill our customers for fees earned, $30,800. And I'm going to make this as of the 30th of the month. Why not? Of course, in real accounting, you wouldn't make up dates. You would know what the dates were. So what are we getting here? We have just sold to our customers $30,800. And we haven't gotten the money yet. So this is now going to be accounts receivable, I before E, except after C, and we're going to increase our accounts receivable by $30,800. It is an asset. We increase it on the debit side. And the other side of that is our revenue. And our revenue account is fees earned. And we're going to put in $3,800. And this is to record sales. Now, let's stop right there and take a look at what we're not doing here in these journal entries. So we are not creating random account names. We're not saying rental expense instead of rent expense. And the reason that we are calling these things very specific names is because of our chart of accounts. So the only names you're allowed to use on your journal lines are these names from your chart of accounts, okay? So you don't want to start calling your revenue account revenue or fees revenue or professional fees or anything else because the name of your account is fees earned. So if you start getting all crazy and throwing in random things on these lines, it's going to really mess you up, but it's also going to mess the next person up. So if you are calling your fees earned by some other name, when we get to the point where we're going to post those to the accounts, we're not going to have a corresponding account. So make sure that the names that you're using in your journal entries are the exact names that you use in your chart of accounts. Okay? Important point to note. All right. So let's go back to our transactions. What happens next? We're going to pay some automobile and miscellaneous expenses. Okay, this is going to be fun for you. You just don't even know what's about to happen in your life, okay? So we're going to debit automobile expenses, or we called it, sorry, auto expenses. Don't want to be making up account names. We're going to debit that for $13.80. We are also paying miscellaneous expenses. So we are going to enter miscellaneous expenses as a debit of $1,800. So how are we paying this? We're going to pay this in cash. And that cash is going to be a combination of those numbers, which my patented lightning fast board math would tell me is $31.80. So this is why this is so exciting. You have just done a compound journal entry. I'm so proud, really, really proud. So this is an example where we have more than 2 accounts being impacted. So in this case, we're doing 2 different expense accounts. So we've got 2 expense accounts and we've got our cash account. So 3 different accounts being impacted. And again, we got to make sure that those are in balance because everything has to be in balance. But that's an example of a compound journal entry. So big step in your accounting lives right there. So proud. Now what happens? Well, now we are going to pay our employees. So we are going to debit salaries expense for $7,300. And how are we paying them? Well, they're not going to take promises. So we're going to pay them in cash. We're going to cut them payroll checks. So we're decreasing our cash by $7,300. So I got so excited up here about your compound journal entry to record auto and miscellaneous expenses. I forgot the description. To record payroll. There we go. All right. So then what happens? Then the old tricky supply entry that we're going to do. And as I mentioned in the other videos about this particular transaction, they're actually sneaking in a Chapter 3 item. So this is an adjusting entry. So not only have you done a compound entry, but you're about to do an adjusting entry. Don't you feel accomplished now? This is great stuff. So this entry, we have determined that the cost of supplies on hand, what we have left over, is $12.50. So the cost of supplies that we used was $20.50. So we're going to move from our supplies asset account. We're going to move this now into our supplies expense account. So here we go. Here's our supplies expense. And we are going to increase that by $20.50. And we are moving it out of our supplies asset. So we're reducing our asset by $20.50. So this is another really good example of why you have to be very careful about what you use for account names in these journal entries. We've got two accounts that start with supplies. So if you mean supplies expense, but you say supplies, I'm going to put it in the wrong account. So you're going to be very careful that you're very specific about using those correct full titles. So here we go. We have moved it out of our supplies asset and into our supplies expense. We've just adjusted that account, and that's why it's an adjusting entry. And here we go. To record supplies used, or something along those lines for your description. And then as our final transaction for June, we are going to, our business owner is going to withdraw some money from the business. So in this case, we want to use our Joe Smith drawing account, and we're going to put our $13,800 in here, our $13,800 in here, and then 1, 2, 3, cash. We are reducing our cash by $13,800. So what we've done with that transaction is we have reduced his capital, his equity in the business, because he's taking some of it back out again. To record owner's withdrawal. All right, well, there we have it. That's our journal entries. And you know what happens now? We get to go home. No, we don't actually get to go home because there's a whole other step that goes along with this. So let me jump over to that other step. So once we've done all of our journal entries, then we need to actually go and post them to our accounts. So this is kind of like what we did with our T accounts, where we were posting things directly into our Ts. This is the expanded version of our T account. So this gives us the debit and the credit. It also gives us a balance line so that we can keep a running balance of what's going on in our accounts. So when we're talking about posting to these accounts, again, we're being very specific about those account names so that we aren't confusing supplies and supplies expense, for example. And then we're going to take each one of those individual journal lines and we're going to enter that debit or credit in the appropriate account. So here's an example. We're going to put in our date. We're going to put in whether it was a debit or a credit, and then we're going to carry that over to the balance, and we'll keep a running balance for each one of those accounts. In particular, when you're thinking about your cash account, you want a running balance. You know, think of it like your bank register that you keep for your checking account. You want to know what your balance is so that you're not writing bad checks. So this is a much more efficient way of doing this as far as comparing T accounts to this method. Now, when we take our journal entries and post to these accounts, you're going to see that it is a very tedious process, right? And it's going to make you appreciate accounting software so much, okay? So let me just jump over to the solution part of the spreadsheet so you can see what's going on here. So here are our postings to our various accounts. All we've done is we've gone to each transaction. So here's our very first transaction where we said we were debiting our cash account. And then if we jump over to our equity account, here's the credit that we did. Okay, so that's what we're doing. We're going back and forth between those different journal entries and our general ledger accounts. And we're going to enter each one of those lines one by one. Now, one of the things that I've seen students try to do as a shortcut is to go through and post like all of the cash transactions, right? Because they think they're saving themselves some time. And then what happens is when they get to the point where they've entered all of these transactions, it doesn't come out correctly. And then they're faced with having to go back through step by step and try to figure out where they went wrong. So the best practice would be to take each journal entry and enter it one by one all the way through this whole process. Now, what I'm not going to do to you is go through and painstakingly enter all of these transactions because it will drive you nuts, okay? And I don't want to do that. So I'm just going to do a sample one. So let's say we have our first transaction that we just mentioned, and it was a debit to cash for $55,000. We're going to get rid of our little X's here that were just a placeholder. So we're debiting cash for $5,500. It is our first transaction, so we know that our balance is $55,000. And then we'll jump down to our capital account where we are going to enter our date. And we're going to enter that credit that we did in our journal entry for $55,000. And our balance will be $55,000. And then you're going to go through each and every transaction. Now, let's say you have a transaction to cash that's, say, a credit of $5,000. I'm just making that up. There is no entry for that. So then that's going to change our balance. We're going to take our debit balance of $55,000 and we're going to subtract $5,000. So our new balance is going to be $50,000. And again, you don't want to be doing anything over here on this other side unless your balance goes negative in your cash account. So you only want the balance on the side where it should be. So once you have posted all of those transactions painstakingly, entry by entry, you're going to take your balances from those accounts and you're going to bring them over into a trial balance. And we're going to just enter those balances that we pull from our accounts. So here's our 38,430, and we're going to go right down the line. And when we're all done, we should tie out debits should equal credits. And again, it doesn't mean that everything is posted in the correct account. Maybe you posted in the supplies asset account and you should have posted in the supplies expense account. Your debit's going to still equal your credits, even though your debit's in the wrong spot, if that makes sense. So all this is doing is checking to make sure that your debits equal your credits. And what this is a holdover from back in the olden days when I was just a young accountant. And we had to do all of these periodic checks throughout the accounting cycle. Now, again, when you're using accounting software, you're not going to go through this process because when you do a journal entry or you enter a bill or you enter an invoice for your customers, your accounting software is going to automatically post those transactions to the accounts. And then it's going to automatically create this trial balance account. But for the purposes of your first accounting class, you're going to have to suffer like the rest of us have suffered over the years and years and years that we've been teaching it this way. So get through it in Accounting 1 and know that you're never going to have to do this IRL in real life. Okay, so there you have it. We've now done our transactions 3 different ways. We've done it using a spreadsheet with the accounting equation, we've done it using T accounts, and we've done it doing journal entries. So that gives you a good idea of the 3 different ways that we do this, how they work, the fact that we all end up at the same place at the end, and the really great news that I'll leave you with, that you're never going to have to do this again when you're done with accounting class. So until next time, stay balanced, my friends.